welcome. You're watching a special broadcast here on News9 Live. I am Krishna Kumar. As we head into a brand new year 2025, we're putting the focus on India's economy and how India's economy will grow in the year 2025. And more importantly, as the economy grows, will inflation be brought under check? That's another big question as we discuss the GDP numbers, as we always do. To understand this better, I have my colleague Karthik Malhotra joining us here in the studio. We also have our special guests in Mr. Indranil Pan, Chief Economist at Yes Bank, joining us. And we also have Mr. Vivek Kumar of Quant Eco joining us on this broadcast. Thank you so much, both of you gentlemen, for joining us. Before we come to you, let's put things into context, Karthik. Fact of the matter is that as we end the year 2024, the concerns were, why is the GDP growth number coming down while the inflation number was going up? In fact, for the month of October, the inflation number was above that our Reserve Bank of India's comfort range of 4% plus or minus 2%, that is 6%. It went above 6%. Thankfully, it came down below 6%. But the fact of the matter is that inflation has been a major concern, and adding to that concern was what happened with the GDP growth numbers.
You're right, Krishna. So I think, the RBI also for once has taken the stand already and said that it is going to look at a revised GDP growth number from 7.2% projected earlier to about 6.6% now. So while there is growth and while we will continue to remain among the fastest growing major economies in the world, that clip of growth rate has certainly now been estimated to the downside from 7.2 to 6.6%. You also mentioned inflation. Yeah, I mean, unfortunately, inflation stemming high largely from food inflation, again, is something that RBI, to my mind, and our economists on the show will be able to educate us better on this. To my mind, RBI has very little control on food inflation. It seems to be a supply side problem, but by keeping rates high, RBI at best can only curtail demand to a certain extent. So is that demand going to really solve for inflation or not? We don't know. But I think to put things more in perspective, what we as an economy definitely need in 2025, in fact, it's something we needed in 2024 and 2023 as well, is the fact that we need more jobs. Now, how are these jobs really going to come about? Number one, I think you definitely need more private sector investments coming in. Those private sector investments, again, are linked to the rate. So obviously, any sort of haircut when it comes to interest rates is going to augment well for private sector's cost of capital to go down. Now, will the new RBI governor really do that in the February MPC is something that we will have to wait and watch for. But there is another event before that, which happens to be Budget 2025. So, where are we going to be when it comes to the fiscal deficit, the current account deficit, and overall tax collection? I think all these are areas that we need to focus on in 2025 as the year kicks in.
Right, that's what we're focusing on here on this special broadcast, the macros of India's economy. Indranil Pan is with us. Indranil, talk to us. There is huge concerns now, even as the growth rate for the current financial year is being reduced below the 7% mark. There are huge concerns on what exactly is going on with India's growth. I mean, fact of the matter is that we've been talking about how India has been the fastest growing major economy in the world. It still continues to be the fastest growing major economy in the world, but that hasn't changed. Fact of the matter is that any growth rate below 7% is a cause of concern.
Well, I think basically, I think there are still problems in terms of the structure of the economy. So at the outset, I think one thing that clearly can be pointed out is that while the macros look good in terms of, however, the growth rate, being the largest growing economy at this point in time, the inflation is relatively on the downward journey once again. We have had or talked about significantly on how external sector dynamics are positive for India in terms of a contained current account balance, etc., and how the RBI had been able to manage the currency. Now, beyond that, I think this is broadly the macro sort of scoping of the economy, and we are very happy about to see these numbers. But the micro aspects are something that we still need to work on very significantly. One, you did point out the employment generation side of the picture. So India has seen significant amount of jobless growth, and unless we have jobs coming up and income spreading or more equitable distribution of the incomes that are generated in the economy, it would be very difficult to see sustained growth in the Indian economy. That's point number one. Now, point number two, it's very clear to see, and by the way, the RBI has sort of looked at the overall financial sector risk as a perspective. The household indebtedness had definitely sort of gone up quite significantly. Now, my understanding and analysis of this is that we are possibly still carrying some amount of the deadweight loss that we created during the COVID period, where people had lost their jobs, and those who even got back to their jobs, maybe it is at a lower wage growth than what it was pre-COVID. So that sort of a sort of strain on the economy or a deadweight loss out of the COVID period continues, which necessarily means that the indebtedness of the household sector has sort of gone up, either because of the medical reasons or because of sort of trying to meet ends meet, which has led to the RBI to increase the risk weight on a lot of unsecured loans. And that is also sort of pulling down, in my opinion, sort of the perspectives or the way we want the private sector consumption to go ahead. Now, in the midst of all this, we also had the elections, and which sort of crunched or pulled down the capex of the government sector in a very significant way, and that's what is showing up in the growth. So I hope that growth will revive, because the government is sort of attempting to increase the expenditures from now till the end of the year. So the H2 growth for this year is likely to be better. And with expected rate cuts by the Reserve Bank of India, FY26 growth, as per our estimate, is somewhere likely to be placed at 6.5 to 6.6% from the current year's estimate at the Yes Bank at 6.2%.
Okay, Vivek, if I were to bring that to you, where does your expectations lie when it comes to India's GDP growth rate in the new year 2025? Vivek, if you can please unmute yourself.
Sorry about that. I would probably agree broadly with what Indranil said in terms of growth. So just maybe brief mention about how things panned out in the last 2 years. And last year we saw the market, including the policymakers themselves, underestimating. And that is the reason why GDP growth, kind of surprised pretty much positively on the upside in the last year. We had a headline print of 8.2%. On GVA basis, we were at 7.2%. And the entire market was surprised positively by at least 50 to 100 basis points on the upside. Now, this time around, the surprise is on the other side. So it's, in some sense, it's kind of normalizing what was positive the previous year is turning out to be negative this year, and we are settling at a long-term trend of somewhere close to 6.5% on a GDP basis. So to me, it's more a case of a mismatch with respect to expectations rather than anything being wrong with the Indian economy as such, because we are still continuing to grow at a long-term average. Now, from the perspective of next financial year, so since Indranil has already talked about some of the micro aspects related to the GDP growth, now, from the next financial year, there are many moving parts, and the most important moving part is going to come from the global side, where we have a new president-elect in US, and he has promised to use tariff as a tool for international relations. He's promised to use tariff as a tool to punish, according to him, nations which have not kept their word as far as their commitment to US trade is concerned. So, in a nutshell, the uncertainty with respect to global trade is going to be phenomenally high, nothing like what we saw in the first regime of Trump, because earlier the majority that he enjoyed was somewhat lower than what he's expected to see this time around. He has complete majority. So technically, he should be able to push through whatever he has promised. While there might be some infighting in between the government and the corporate US corporate sector, there might be retaliation from their export partners. But net, the result of all this is likely to be more confusion, more policy uncertainty from the perspective of global trade. and which traditionally or conventionally has not been a good, uh, let's say, leading indicator for domestic investment performance, or for that matter, domestic exports. So that's one angle that all of us will have to keep in mind. And there are various estimates by multilateral bodies which have uh, which have been out in the last 1 month, and the numbers that are going around is that the global GDP could be lower by 1 percentage point if Trump implements what he has been promised, which is something like a 60% tariff on China, 25% tariff on Mexico, Canada, and a blanket 10% tariff increase on all other key trading partners, including India. So that's something, a very important factor, needs to be kept in mind. The second aspect I'll borrow from Indranil's point, which is the slow but gradual tightening of domestic credit conditions. Now, part of it is engineered because there was a policy tightening, and we are still probably onto the last leg of the policy tightening, which is currently playing out. We are seeing bank credit growth moderating, and from a regulatory side, there is a lot of tightening on the NBFC credit. So all this credit-led growth, which was pretty much supporting consumption to some extent in the last 2 years, will see moderation. The telltale signs are already evident in terms of urban consumption slowing down in India. So that's probably a leading indicator of what could lie ahead in 2025. The last, I would say, but not the least, is something which I would say is a silver lining among all these uncertainties, is the performance of India's services exports. So far, last 2 to 3 years, especially since 2021, we've seen a phenomenal rise in India's software exports along with business services exports. And as we stand today, the software services, or the surplus that software service, the entire services surplus that contributes, helps us to finance almost 70% of our merchandise deficit. So that's a very big number, and that gives a lot of comfort, something which we also did talk about, that we are fairly comfortable as far as our trade deficit is concerned, current account deficit is concerned, and that to a large extent is because of the structural increase in services export surplus that India has been enjoying in the last 2 to 3 years, thanks to all the GCCs that have mushroomed in the last 3 years in India. So this probably would be the silver lining for us. Otherwise, there are points of concern on the global side, most importantly, and the urban part slowing down. The rural recovery has already started, and we would expect with healthy Rabi sowing, which probably would be towards the fag end of the current financial year, to start having a somewhat of healthy impact somewhere around mid of 2025. So by and large, within the consumption space, there will be reallocation between urban and rural sources of demand. Um, Global, we all need our antennas to be fairly active, and some bit of reprieve, some bit of comfort to be drawn on the services exports.
Krishna, if I can just come in here and
Right, sure.
add to what Indranil and Vivek have both really highlighted very eloquently on the show. But I believe while the credit growth, and let's look at domestic and global factors separately. Domestically, while the credit growth has pretty much tapered and come to acceptable levels, the anomaly in this happens to be gold loans. So, cash against gold, which pretty much means that you're putting your household jewelry on mortgage to take some cash to fend for day-to-day expenses, is something which has been on the rise, which to my mind is a worrying trend. And this sort of takes us back to the K-shape recovery debate that we had in 2021, 2022. That was our recovery really K-shaped, that the haves and the have-nots and the inequality actually grew by such extent, and the inequality became so apparent that in some cases we are talking about the wealth of the rich increasing while the poor happen to mortgage that gold. I think that is definitely one worrying sign, one cloud. I mean, we'll come to the silver lining separately, but that is definitely one cloud which is looming large. Now, on the international front, I believe we also happen to be in a position where perhaps we made the mistake of underestimating China's slowdown and hoping that that trend is going to continue forever. Now, despite the potential trade tariff war between US and China, there's enough and more that China is trying to do itself by way of stimulus and monetary loosening to really prop up demand. So that is something that, again, we need to be watchful of, that while at some level people say that, an India-China comparison may be an outdated debate and we should look at our own growth journey and we should have our own Viksit Bharat 2047 ambitions. But I think we live in a coupled world where what is happening in China and what could potentially happen in China is not something that will not impact India. It will definitely impact India. Investments into India, exports out of India. Now, FDI exports, for example, just to spitball a number here, I think we've seen $1 trillion worth of FDI exports coming into India from the year 2000. So, in a 25-year period, while some publications and government agencies are saying, wow, $1 trillion is a big figure, compared to what our growth aspirations for the economy are, I think FDI of just $1 trillion worth seems to be a very, very small number, and that is something by way of policy. I mean, structural reforms and structural tweaking is something that can keep happening. But I think we really need to make sure that schemes like PLI and sort of the overall ease of doing business investment climate in India continues to remain friendly, so that we see the FDI really come in, and that sort of compensates for the high cost of capital that Indian companies face until we live in a high interest rate regime. So that was one. So, number one, gold loans. Number two, China's own loosening of the policy. And number three, I think we've just got to make sure that we have enough and more robust measures in place to have investments come into India. And it's not just going to be Vietnam and Philippines. Many economists believe and trade experts believe that story has played out. Well, there's nothing stopping from a chapter 2 and chapter 3 of that trade story. How do we as India remain competitive in attracting this volume of business coming into India is something that I think the year 2025 will have to define very clearly for us.
Oh, definitely. And the other factor for growth and ensuring that growth numbers stay at a particular level is the growth of the rural economy, Karthik, isn't it? I'm just going to put the focus away from all the exports and other stuff to back to India, back to what's happening on ground. The rural economy continues to be a laggard, is not performing up to potential. Indranil, so do you think for the year 2025, if we want to prop up those GDP growth rates, it's important that we put the focus back on the rural economy?
I think that's a very important point, in the sense that if I really, even beyond, I think the whole debate has been around how agricultural growth has been or should be instrumental in pushing rural demand. Now, at the margin, maybe that sort of a debate is right, and we can look at higher agricultural returns to actually push up growth. But I think two things that clearly stand out is, one is the gold loan bit that was just talked about, which clearly indicates that there is still some amount of stress in the Indian economy that I also did allude to. Now, coming back to the sort of rural segments growth, the debate actually goes back to whether we should look at the headline CPI, and or whether we should sort of forget about the food and look at the core CPI. The fact of the matter remains that unless we look at the headline CPI and bring it down, the real wage growth in the rural sector, be it the agricultural wage growth or be it the non-agricultural wage growth, continues to suffer in a very significant way. And that, to a certain extent, sort of hampers the type of turnaround that we have been expecting in the rural segment. Now, the second thing also that remains important is that unless we pull down also the food inflation. Now, I'm not going into the debate who is responsible for pulling down the food inflation, whether it is the supply side or the demand side. But unless we are able to pull down the food inflation, let us remember that within the agricultural sector in India, the most significant sort of farmers are actually marginal farmers with possibly not adequate marketable surplus to bring into the market, sell it, and actually meet the expenditures on other items. So, for example, if a farmer is, say, producing rice or potato, leave aside tomato, which also has given heartbreaks to a lot of farmers in recent years, when you had a surfeit of tomatoes, but you didn't know how to store it and therefore sort of moderate the price fluctuations and volatility in the remaining part of the year. But when these sort of items, either the cereals or the potatoes, come to the market, they ultimately have to buy edible oil. And edible oil in the last few months have been on the higher side. And it's not just a cyclical issue. I think the problem with edible oils, the problem with pulses is that we are significantly dependent on imports. And for example, edible oils in Malaysia and Indonesia, again, due to the development and the way urbanization has happened, we've actually reduced the output of edible oil seeds in a very significant way, and which is impacting the prices of the edible oil. So these, to a certain extent, reduce at the margin the disposable income that a farm sector person would have, be it agriculture or a non-agriculture, to actually sort of go move into discretionary consumption. And hence, in my opinion, it is absolutely important to not only look at the core inflation, but actually look at the headline inflation, to actually sort of provide that sustenance in the growth that we are looking at.
Karthik, we were discussing everything from the rural economy to the possible impact of China's bounce back impacting India's growth rate. Let's also talk about the fact that, for India's growth rate to go further, all the questions surround whether India will get a rate cut or not. Whereas rate cuts are happening across the board, globally, in Europe, in America. There could be possible advantages from all of that for India, because India's IT sector is heavily dependent on the US market. And if there's a rate cut in the US, it will be a big boost for India's IT sector.
You're right, absolutely. I think, when we saw earlier this month that earlier in the month of December, when the US inflation rate had come out at about 2.7%, now despite that being higher than the previous month period, the idea really was that it is still a good inflation number, and hence a rate cut by the US Fed is going to actually not just prop up the US markets, which it did, but we also saw Indian IT companies really, and Nifty IT really hit a record high. Now, all that was some time back. I think right now what is definitely important for us to understand is the fact that with any rate cut in the US, any sort of easing up, freeing up of and cutting down on the cost of capital, the companies based in the US will have a lot more discretionary spending ability in their pockets, and that is obviously going to augur well for India's IT sector. Now, India's IT sector, of course, is heavily dependent on, like you mentioned, both the US as well as Europe, and any sort of any sort of tailwinds in that sector are going to impact positively India's IT sector. Now, this of course has 2-3 advantages as I see them. Number one, of course, is going to be job creation, which obviously is the number one priority, should be the number one priority of the Indian government as we head into 2025. So IT sector jobs is something which I believe 2025, with rate cuts in US to continue, is likely to see some sort of an upward momentum. In addition to that, you also have India's sort of net exports. So while the effort is to pivot from an IT-driven economy to a more manufacturing-led economy, I believe at some point that whole journey is going to take some time, and until then services will continue to contribute, especially in the net exports basket of India. So IT exports should increase in 2025. Hopefully, at least that is what the the hope is right now, and that should sort of augment this GDP slowdown growth story and make it a little more robust overall for the economy, not just for the IT sector.
Vivek, a rate cut in the US could well, have a boosting effect as far as India is concerned, because, India's the services exports are all about India's IT services exports. Talk to us from that perspective. Can it sort of cushion the slowing in the growth rates for India's economy? Please unmute yourself, Vivek.
Sorry about that. So definitely the resilience that the US economy has been showing for a major part of 2024, and the outlook that one has for 25, which is much more constructive than what it was 6 months back, is good news for service exporters, especially the IT sector as a whole. Now, while that's a tailwind, there are a few headwinds also along the line. Number one would be a small part of the revenue is also coming from Europe, and Europe is facing or flirting with almost zero growth scenario. We saw what the ECB did, a few weeks back in terms of its forecast for Germany, German GDP growth. So that's almost close to zero. So the moot point here is that while yes, a major part is constructive, there is some headwind which is probably going to come from Europe. At the same time, there is likely to be some immigration issues which probably could resurface in the Trump 2.0 regime. So whether the issue of H-1B visas come alive once again, as they did in the Trump 1.0 regime, is something which one needs to see, because there have been high decibel noise or high decibel positioning when the US elections were underway. So we probably have to weigh both these impacts, along with the fact that the US economy as a whole is much more resilient than what it was 6 months back, which is from a demand side perspective is good news. But from an policy intervention perspective, these could be some of the hiccups that the sectors or the US dependent sectors in India could possibly face.
Right. Let's also talk about what is impeding growth in India, and that is inflation. Indranil, we saw inflation go above the 6% mark, 6.2%, outside the Reserve Bank of India's comfort zone. It is back within the comfort zone, but still is on the edges of it all, because it's still about 5.4 or above 5.4%. So in that sense, it is, and it's an inflation that is essentially being triggered by food inflation. What do you think will be the inflation's roadmap for the year 2025, considering the fact that food inflation is out of everybody's control, especially the Reserve Bank of India's control?
Well, I think I'll try to answer this question in a slightly different way, and sort of keeping the Reserve Bank of India away from this whole debate. Let us realize one thing, or at least what I see, is that inflation is probably more structural in the global economy and also in India, compared to the pre-COVID levels, and especially after the 2008 global financial crisis, when inflation was almost at 0% globally. And whatever the central banks used to do, including the negative interest rate sort of story, was not being able to push inflation on the higher side. So I think the critical issue to understand here is that there is a pressure on China, and there's a pressure on China in terms of the tariffs that the US might be raising, which necessarily means that we are looking at supply chains getting distorted once again. So that's a big thing for inflation in a structural way going forward. Number two, we have seen significant amount of climate changes, late rains, flooding, sort of various natural calamities, which to a certain extent is preventing the global economy from building up the buffer stock that it needs to signal that food inflation globally will be on the lower side. So that's the other sort of big issue that one needs to look ahead to from a global economy perspective, and all the climate changes that we are experiencing. And to that extent, looking at some limitation in terms of how food inflation can actually come down. The third issue is that there is a significant demographic shift that has happened globally towards sort of an aging population. And I think what, from a macro perspective, what is likely to be happening or is already underway is that globally there is more sort of perspective on savings and current consumption, because you have to take care of the older generation people. And there is a relatively limited sort of push that is happening towards the investment side, which therefore is likely to, on a slightly longer term basis, lead to productivity loss in the global economy. And associated with the supply chain issues that are likely to come out, along with what Vivek was pointing out in terms of the immigration issues that are likely to come up. I see a more structural bias on the inflation side, and therefore I'm not really too hopeful of inflation on a very sort of sequential basis and the directional basis in India. to come down, settle at 4%, and we are all happy about it. That is possibly not something that is likely to happen, in my opinion.
Okay. Let's now also talk about the tax collections in India. Karthik, you've seen the direct tax collection show solid growth, but strangely, it's the GST collections that seem to be slowing down. It recently hit a 40-month low. Talk to us. That is an important factor as far as India's overall growth is concerned.
No, you're right. I think, again, GST is basically the tax that you pay on buying any goods or services. So overall, if the consumption story in India tends to get weak, it will have a direct bearing on GST. However, I think there is a sort of notional and real aspect to it as well, that with inflation, technically GST collection should go up, and that is something that we have seen. With prices rising, the tax component on those increased prices should actually help you increase your GST collection. But I think it is largely, when you look at the consumption story, separately from inflation or even coupled with inflation, you see that maybe the consumption slowed down is more than sort of outweighing the price increase to really get the GST numbers to go high. But having said that, I think we have seen 2 lakh crore rupees in GST collection as well in the month of March, which in any case is sort of, an anomaly, and you see March collections in general being much higher than the rest of the year. But on the tax collection front, I think fiscal deficit is something that the finance minister, the government wants to keep in the narrow lane. And honestly, I don't know, I think the economists will definitely disagree with me on this show, but I believe there is some merit in exploring the wealth tax debate. I mean, we heard Thomas Piketty, the French economist, saying that perhaps India's tax collection can soar multiple times over if the wealthy are actually subjected to a higher tax rate. Well, I know the argument is that that will eventually result in flight of capital, but maybe there is some merit in entertaining that discussion for a bit.
Well, wealthy tax, and the wealthy we hear are already moving to Dubai and London and God knows where else because of the high taxation in the country. But Vivek, talk to us, GST collections not growing at the same pace, coming in at multi-year lows, whereas direct tax collection continues to grow. But the fact of the matter is that the consumption story in India needs to be as strong as ever in the year 2025 if India hopes to put up the kind of growth it wants to.
Yes, definitely. So GST numbers are reflecting that, and it's not just the domestic consumption bit. There is also an import angle associated with GST. So part of GST is also because of imports, and both are slowing down. In my sense, the slowdown from imports is outpacing the slowdown that we are seeing on account of domestic consumption at this point in time. Having said so, the shortfall that possibly might be there in terms of GST is not likely to be huge, because the budget had penciled in roughly about 11% growth in GST collections. So we are somewhere close to that, a little bit a tad lower than that. But yes, the broader point that you made does hold, that if one has to see a sustainable level of growth, then GST numbers should start reflecting that. And any sort of tinkering with respect to GST, we know that the GST Council is considering few important changes as far as which will have a bearing on domestic consumption. Those need to be implemented and possibly followed through only by having a proper assessment and proper analysis of its impact on domestic consumption. So I'm talking about here, items which are related to mass consumption, especially, and those should be implemented or assessed only after the proper consideration has been made in terms of the impact on consumption. Now, I think I missed the latter half of the question. If you could possibly repeat for me.
Right. Indranil, the only question left to ask is it time for a wealth tax in India? Indranil.
Well, I think it's quite debatable. It's quite debatable
It is, but
in the
which side of the
sense.
debate do you stand?
No, so I think we have to look at the debate in the sense of whether or not it will improve your macro space. Now, I'm not sure again how much you will be able to collect from the wealth tax, and whether it will be just a drop in the ocean when you actually sort of look at the whole scenario. in terms of the contribution of that in the revenue generation aspect of the country. Now, to a certain extent, the government has in the last budget already tightened the capital gains tax aspect, and that, in my mind, should help in the medium term. And sort of we need to look at what is the type of revenue generation is happening from that perspective, rather than bringing in the wealth tax immediately. So the problem with the wealth tax is that it affects only a certain portion of the population, but I'm not sure whether the collections will be enough for the percolation effect to take hold and penetrate into the rest of the economy. So the benefits of taxation, it's not taxation per se only, but the benefits of the taxation has to percolate down to the economy, and that's the role of the government. So that is something that the cost benefit analysis needs to be done very carefully, and hence I don't think I'm taking any sides at this point in time.
Okay, so you're not taking any sides, but we will leave it at that. Engineer Pan and Vivek Kumar, thank you so much for taking time out to be with us here on this broadcast. We are looking ahead to the brand new year 2025, and we're trying to map out what will happen to Indian economy's growth, the GDP growth number, which hit a speed bump in the year 2024. Will India's growth rate stay on track in the new year? Take a look at this special report.
Growth in real GDP in the second quarter of this year at 5.4% turned out to be much lower than anticipated.
Actually, we are not the fifth largest economy as yet.
India, China, both have been shifted up.
We have not crossed Britain and France, etc.
We are just better off than we were. That's a calculation, objective. It's not me or my uncle or somebody doing it.
If you disaggregate and you look at the evidence from the unorganized sector everywhere, whether it be textile sector, leather goods sector, whether it be pressure cooker industry, or whether you look at the luggage industry, etc., or the trade sector, there you find that the unorganized sector is declining quite sharply. So if you do that, bring in alternate data for the unorganized sector and don't go by the official methodology, then you will find it be 1 or 2% or thereabouts, for the last 8 years.
I would take the position that it is not that serious, but I'm a bit worried that projection of Indian economic growth for 2025, 2026 have been brought down by all the global rating agencies. That is telling me that is there something wrong in it, in our economy.
We are blessed actually. We have a very good demographic dividend. We have very young people. Our digital infrastructure today is one of the best. Our data consumption, our mobile networks, they're really world class if you look at it. So all of this I think is going to help India grow towards becoming a Viksit Bharat.
I've been in this business for 30 years. I know there will be positive shocks, negative shocks, and if you are looking at the short term, you will keep adjusting your quarterly numbers, monthly numbers.
The Indian economy has just witnessed 4 consecutive quarters of falling growth rate numbers. Growth fell to below 6 for the second quarter of financial year 2025. Capacity utilization is still hovering around 70%. There is, of course, the geopolitical turmoil that just refuses to de-escalate. Food inflation, that makes up for about half of the overall consumer price index basket, has eased to 9.04% in November, down from 10.87% the previous month. but at over 9, it is still a cause for worry. Rural inflation quickened to 9.10% in November compared to 6.68% in October, while urban inflation rose to 8.74% in November, up from 5.62% the previous month. While all this is weather-driven, the figures are worrying. Retail inflation, however, eased to 5.48% in November after breaching RBI's 6% upper tolerance band in October. The arrival of fresh produce helped moderate soaring vegetable prices here.
Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March.
The fact that both fiscal policy, because of elections, etc., was implicitly tightened because generally expenditure slow down, and second, that monetary policy through regulatory measures and other was also tightened, so kind of dual tightening has affected it. Now the expenditure part will correct, so again that is a temporary factor.
We have seen quarterly fluctuations even earlier. After the very high growth rate in 2021, we have quarterly projections revised downwards. That has not made that much of a news as this time it has made. I think we must try to find out the reasons for it. One is that not only the second quarter's growth rate has come down to 5.4%, the projections for the third quarter and the fourth quarter and for the next year, first quarter and second quarter, have been revised downwards. Which means there is something structural perhaps which the rating agencies are discovering. I'm talking about RBI and the State Bank of India also, they have given a projection that there is some structural factor. But one good news I got that although RBI said the annual growth rate will be 6.6%, OECD says it will be slightly higher. They are slightly optimistic. They say that in agricultural sector, some trends are coming up in the last month. The reasons for this slowing down is the industrial sector. The growth rate in the earlier quarter, second quarter of the last year, was something like 14%, more than 10%, right? And suddenly it has come down to 2%. That is a matter of worry if that doesn't pick up.
India's growth story is there to stay. So I think any growth to take off, it's not really going to be linear. So there will be ups, there will be downs. Currently we've had a couple of quarters which have been of concern, but I don't think the long-term story is, we are very far from it. So our growth numbers will pick up. This quarter the industrial output has fallen, but I think with the government spending coming into being, both, if you look at Maharashtra government is now informed, and the growth will continue. So once the capital spending comes, I think these numbers should even out.
Purchasing Power Parity or PPP is a popular macroeconomic analysis metric used to compare economic productivity and standards of living between countries. PPP is the exchange rate at which one nation's currency is converted into another to purchase the same amounts of a large group of products. Why am I telling you all this? According to the Purchasing Power Parity Index, India is already the third largest economy in the world. How about that? By contrast, according to the GDP per capita index, we are not anywhere amongst the top. Toss the coin and take what suits you.
This data that I look at is PPP in 2017 prices. It is a new series which has completely revised Russia, for example. Russia used to be classified as an upper middle income country. They have shifted it to high income. That's how big the revisions are. India, China, both have been shifted up. We are just better off than we were. That's the calculation, objective. It's not me or my uncle or somebody doing it. It's the international. We have to go by that. You will have some leftists saying, oh, this is the weakness. Of course there are weaknesses. But we have to go by some data. और कहाँ से पता नहीं कहाँ से आएंगे?
Actually, we are not the fifth largest economy as yet. We have not crossed Britain and France, etc. Because after demonetization, the unorganized sector has been hit hard. Our rate of growth has not been more than 1 or 2 or 3%. It's not been 7%, right? So we are not yet the fifth largest economy. We need to be realistic. If our rate of growth was 7 or 8%, and the unorganized sector is also growing at 7-8%, we would not have had the problem of unemployment that we face. So therefore, we have to be more realistic about it. All the distress, especially amongst the educated youth, which has been protesting, amongst the women, all that shows that our employment generation has been a problem. So therefore, it sounds very nice, and I would also like to believe that, India is doing well. But we have to disaggregate our analysis. Unfortunately, what the analysis presented is a very aggregated analysis where we don't separate the unorganized and organized and see what's happening to each of them.
The calculation of GDP itself is a matter of deeper study while it is up for debate. How do we calculate GDP? It's private consumption plus gross private investment plus government investment plus government spending plus the difference between exports and imports. Agencies calculate and make projections on the basis of available data. For a country like India, which has a huge unorganized sector, which does not feature in most documented data, data collectors do not even reach most of these people in the space. The available data, therefore, can be questioned.
Quarterly data says that actually for the organized sector also, there's very limited data, what are called the high frequency data. So say high frequency data, government says GST collection is going well, corporate tax collection is going well, direct tax collection is going well, but all this is only organized sector data. GST is not paid by the unorganized sector, it's kept out. So this growth is only reflecting the organized sector growth. Similarly, corporate tax is only paid by the organized sector, it's not paid by the unorganized sector. Income tax also, the Prime Minister himself has said only 15 million are effective taxpayers. These are also organized sector people. So none of this tax data or even say flights data or railway movement data, that's reflecting largely the organized sector. So our data, quarterly data, etc. is based on the organized sector. So a declining sector is being proxied by a rising sector. So therefore, this say 7% rate of growth is only of the organized sector, which is 55% of GDP. So that gives you 3.75%. Agriculture, suppose it's correct, even though there are doubts about it, that even agriculture data is not correct, but suppose it's correct, that gives you another 0.2%. So that makes it 3.9%. And the unorganized sector, which is 31% minus the agriculture sector, if that is declining even at 5%, okay, that gives you minus 1.5%. So 3.9 minus 1.5, so you come to about 2.4%, right? Now when 7% comes down to 5.4%, then it becomes almost close to zero.
I don't know what purpose that served when we are discussing forecasts and what has happened. We go by whatever is the published consistent data. If there's an inconsistency, we have to discuss it. But if it is based on a certain methodology and is consistent, then we discuss that data. That's the basis on which we forecast. If somebody is forecasting on some other basis, on what basis do I discuss it? To me, it's just a red herring. It's not an economic discussion, it's a political discussion.
All said and done, we are still better than most large economies in the world in the present troublous times. While manufacturing has slowed down, some indices are still encouraging. The Purchase Managers Index for both manufacturing and services is still above 55, while manufacturing is on the slide slightly. The economy is in need for an impetus, no question. The RBI has eased the cash reserve ratio for banks, so more liquidity and hence private investment can be expected in the marketplace.
To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is to reduce the CRR of all banks to 4%.
There is a professor of economics, Danny Roderick, at business school in Harvard. He talks about premature deindustrialization. if a developed economy is showing percentage of industrial sector going down in GDP by 4%, 5%, it's not a matter of worry. But for a developing economy in Asia and Africa, if their share of manufacturing goes down from 32% to 28%, it is a matter of worry, because it is not able to withstand the global market fluctuation, and that's what seems to be happening. Our exports of many of the basic items have gone down, and that has badly affected our industrial growth.
This is a competitive world, so I mean, certain industries will go to competing states in India or competing countries in the region. Bangladesh at one time, Bangladesh, Sri Lanka did take a lot of the world share from India, whereas India has always been very, very strong in textiles and cotton, but it did take it away. But the question, are we doing enough to get it back? Are we going to be able to ensure that we will able to remain competitive? So, I mean, if you look at logistics, I mean, India's cost of logistics has been historically very high, 13-14%. Government is trying very hard to bring it down to single digit. India needs to be competitive on all fronts, be it the cost of land, the cost of people, the cost of goods, of course, and the infrastructure costs. So, and of course, cost of capital, which is very, very important.
Now there are about 6 lakh small and medium units and 6 crore micro units. Okay. The policies that are announced for MSME go to the medium sector, but not to the small and the micro sector.
If you can generate income in the hands of the rural population, small and medium towns, and make a delicate balance in tax concessions for the middle class in the large cities and medium cities, for really helping them to come out into the market and boost the middle class consumption, that would be certainly a factor which will result in increase in the consumption expenditure and may stall this downward slipping of the growth rate in coming quarters.